Okay, all set. All right, let's do a little bit change today. Good afternoon. Okay. All right, we've been doing it for almost now 3 years. May I request you to, and whoever can, maybe turn on your video, and maybe we have more discussion than just me talking about it. At least I get some visual cues, visual feedback if you're getting, if you're not getting it. So yeah, that'll be better. And number two is, if I happen to meet some of you, at least I know, hey, you're from that meetup group. So if you don't mind turning on your video, that will be much appreciated. And let's make it more interactive. Right? Have a questions, go forward, ask for it, and yeah, let's make it a little more fun. So I do see, yeah, it'll be, I think, a few minutes before the rest of the usual gang joins. I do see some new names out here. I may say, did not shave. So do it next week. Anyway, I mean, we're not getting headshots for LinkedIn profile, so it should be all fine. Um, you know, again, I don't have a model look myself anyway, but it is fun to at least more humane to see people, and that's why just a request. If you can turn your camera on. Or I do see a couple of new names. Let me go see and understand why you're joining. Siva, is it the first time you're joining?
Hey Vivek, sorry. Yeah, sorry, just got up. It's late. So it's a first time joining. So I've been doing options couple of times. So also I like normally write the programs on the option data. Just want to understand how really the option works. Sometimes if you go prices, when it comes to the expiry date, right? The prices always goes down, right? Though the stock price actually goes up, still the prices are low.
Yeah.
Right? So want to understand more. So want to see get suggestions and inputs from you.
Okay. Yeah. So best will be ask questions, because we talk a lot of stuff here,
Right.
not just options,
Right.
but general stock economy.
Nice.
Because over years, what I've realized is, as a DIY investor, I need to look at overall my portfolio and not just options. Options are
Right.
a tool which I use as a part of my overall portfolio, or my own portfolio management.
Okay. Okay.
And I know where you're coming from, saying, hey, at the end the price goes down, because that's what the theta decay is. You can get as deeper as what you want to be, how much deep you want to get in, but yeah, feel free, ask questions, and then we can discuss more on
Sure.
it.
Sure. Appreciate it. Thanks,
No
Vivek.
worries. And just to I do a few more names just to level set. I mostly sell options, so you hardly talking about buying options, because long term that doesn't work. So and we can have further discussions on why I say that long term doesn't work. Just the math doesn't support, right? If you go back and look at the math, buying options just doesn't work long term.
Yeah.
All right, I see another new name, Ashkan. I hope I'm not butchering your name. Ashkan, is this first time for you?
Yes.
So what brings you here, and how did you find us? What do you intend to get out of it?
I've been watching options trade channels on YouTube, on Discord, and studying about it on Reddit. I haven't actually had the time to start paper trading yet. I do agree with you. Some of the information that I learned is about selling options and not buying. Ultimately, I wouldn't want to learn more about this before I invest money into it. But I'm taking a course right now on Java.
Mhm.
Ultimately, maybe someday I can write algorithm
Mhm.
that will trade for me.
Got
But
it.
it's too soon to say that it's pragmatic at this time.
Cool. Okay. All right. So we got two people who are more interested in writing algos for trading. That's great. We got CEO and Ashkan. So yeah, thanks, Ashkan. And who else? Geraldo. And again, like I was saying earlier, I'll appreciate if you can turn on your video. We can at least have a little more meaningful. I mean, it's easy, better to connect at a more human level. If you have our videos on, I don't. Otherwise, it's giving me a feeling that I'm talking to a bot. All right, Geraldo, if you can hear.
Yes, I'm here. I'm just turning on my camera. 1 second, please.
Yeah, no worries.
Can you see me all right?
Yeah, good to see you.
Yeah, so I found this group on the meetup in the Bay Area, and I'm more of a long-term investor in the stock market, and learning the options game is something that I want to add to my repertoire.
Mhm.
So complete novice, and I'm here to learn as much as I can and provide value as well.
Cool. Very good. Good to see you. Welcome. And again, I'm a long-term investor. So I'm not the one who just trade only in options. The reason I got into options was because I want to stay as a long-term investor and want to, hold my stocks forever. Right. My
Right.
minimum holding period is 10 years, but
Right.
my ideal is forever. And now whatever helps me to stay is what I want to do. And option is one of the tools that I found has helped me to stay longer in the market. And
Right.
that's the way I use options. Okay.
What do you
Sure.
what do you think of holding on to stocks forever and just taking loans out against them so you avoid those capital gains?
So if your broker good question. I'm going to actually talk about this topic because today one of the topic is cost basis reduction.
Fantastic.
And I will talk about it in terms of what are the various ways in which you could reduce your cost basis and why we should focus on reducing your cost basis.
All
So
right.
hold on to your thoughts.
Looking forward to it. Thank you.
Right. And those who are new to, again, in this session, now looks like there are a lot more new folks on options. Maybe in my next session, I can start getting into more basics around options. But if you have some time, then I think I shared that last week is a while ago, I did a whole options boot camp and I have the recordings uploaded. There's a series of almost 13 videos, which basically talks about the very basics of options, starting from there all the way to how to use options to manage your own portfolio, right? Which talks about options, Greeks, explorations, theta, delta, everything, all the way to looking at your portfolio beta, very delta, which is what, if you listen to hedge funds, all they do is a delta hedging. So I've covered all those concepts. And if you have time, you can do on your own. You might as well go through. I just shared the link in the chat. You could go through that if that helps you in your own journey. And yeah, feel free to ask questions and we'll be happy to answer to the best of my capability. Again, I'm not a full-time trader or a professional investor or an institutional investor. I'm just a like regular retail DIY retail investor, and that's what I focus on. All right. Cool. So let me just, anything else before we jump onto our session? Okay, looks like all good. Let me just share my screen. And we go from there. Okay, so what do I want to talk about? Definitely, I think there's one topic that I wanted to cover in my the last week's meeting. We did not. I hope we'll be able to cover it this week's meeting, is to go through Cloud 100 report from BVP, Bessemer. So basically benchmarks, not the best, but from a BVP. And the other thing is I want to focus on importance of understanding cost basis. The reason why I want to talk about cost basis is something that I saw on Twitter, and looks like this is one area where most retail investors kind of don't pay attention to. And in the long term, this really works out well if you understand your cost basis and also how to reduce the cost basis, right? And of course, we'll talk about the general macro and all that stuff. Okay, I have a hard stop at 12 because I have to go somewhere. Otherwise, generally the sessions goes around till 12:30. In rare cases, we've talked about almost 3 hours, but today I have a hard stop, so I need to be at some place, so I need to leave, and we'll end the session whenever the clock hits 12. Other thing is there will not be any session next week. I'll be traveling, so then we'll meet again on September 9th. So no session next week. Find something else to do for these 2 hours. Okay. All right. So let's get a little warmed up. Something that caught my eye was around this company called better.com. The company has been in news or infamous, I think last year, or 2022, when the CEO fired almost few hundred people over Zoom and all that stuff happened. The eventually company went IPO. The reason it came onto my radar was the day of IPO, the stock fell down 94%, right? The question to you all is this a good IPO for a company or bad IPO? What do you think? If you're an investor, is this a good IPO for a company or is it a bad IPO? Stock is down 94% after
it's really bad, right? 94% is terrible.
My question was, is it a good IPO for company? So the reason I asked you, I just want to provoke your thoughts in terms of make sure thinking process, and we focus as understand how these IPOs and what is good versus bad on IPOs, because traditional financial media doesn't tell this. Stock goes higher, they say it's a great IPO. I'm like, for whom? The question is great IPO for whom? Now this, I would say this was a great IPO for the company better.com. They raised $8 billion. So company got $8 billion worth of money, right? Now the shareholders who bought it later on in IPO is bad for them. But for a company, it's a great stuff. So when stock price go 50% higher, and then you see financial media talking about it's a great IPO, I'm like, no, company left a lot of money on the table. Company could have raised $10 billion and they raised only $7 billion, whereas its worth was $10 billion because that's what the public market says. So from my perspective, this was a great IPO for the company. Company is able to make, I think they raised almost $8 billion or something. And whereas their worth was only $1 billion. So they got a lot. So from their perspective, it's a great IPO. It is not a good IPO for the bankers who sold the shares to their high net worth clients prior to IPO, because the banker's friend or the institutional investors who bought the shares, they are down whatever 93%. So see, just understand the difference between who are we talking about here. So if I'm owning shares in the company, I would want to make sure that the company gets most of the money and not the bankers, not the bankers' friends. So if a stock price goes high after IPO, for my perspective, it's not a successful IPO for the company. Company could have raised a lot more money, but bankers didn't value them. whereas the public market would have said, hey, you're of great value. In this case, great IPO for the company. Optics, media will say it's not a good IPO, but company raised $8 billion. Now you can use that money for whatever they want to do. Just says Robert. Second thing is around, again, something came across me, is drip, right? And I've shared earlier, one of you had donated, send some donation across my way for some books. So I've been reading those books and bring you some of the stuff that I learned from that book. And one thing that I want to talk about is dividend reinvestment plan, DRIP, commonly known as DRIP, right? And how important sometimes that DRIP could be. Where that go? All right. Right. But this is a chart that compares the S&P returns. On the left one, this is the capital gains only. And this is on the right side, this is with dividends reinvested. Right? Many times when you hear S&P has returned 11%, 10% over long term, that's all considering is a dividend with dividend being reinvested, right? And it does make a huge difference, right? It's almost because dividend rate is almost 3%, plus you get compounded on it. So on a bull market, if you look at, the difference is almost 4%. In some cases, it's 6%. Even on the bear market, with dividend reinvestment, the S&P has done much better. So if you are just an index investor, you may do better by, reinvesting the dividends. Now, as a retail investor, many of the time we would want to say, oh, no, I'll get the dividend, and then maybe I will reinvest myself. Either you could do that, or your brokerage platform allows you to reinvest the dividend, maybe make use of that. So something came across, thought I'll share with you. Probably it's a public knowledge, but when I talk to my friends, etc., not everyone actually does the dividend reinvestment. If you get the dividend and then you spend the dividend on whatever you want to, then you don't get that 8 to 10% or 11% on an average return from the market. Other thing is, I'll just read through it, and then we can say, this talks about booms and the bust, right? During the boom time, often boom times mark a major technological advance, the discovery of a new resources or new lands. But since the limit of the new discovery is unknown, there is no clear way to measure its value. The prospect for the profits is open-ended and lacking a measuring stick. The human imagination tends to err in the direction of the desire, envisioning boundless profits. So today, in today's market, this is what we are seeing with AI. And by the way, what we are seeing, at least what I'm seeing in today's market around AI, where all the VC money is going into AI, customers are only spending on AI specific tools and software, all other expenses are down. And the stocks that are working are the stocks that are in AI. Every earnings call, whether you're a tech company or not, even if you're a grocer, even if you're a retail company, everyone is coming and talking about AI, right? So from my perspective, this is the story that we have seen earlier. By the way, this excerpt from the book is talking about it's 1990 to 1999. So this is not the first time that is happening, right? These things have happened time and again, and that is why I'm cautious. I'm optimistic, but little cautiously optimistic on all the Nvidia mania that is going around in the market. This is never seen before. Saw similar stuff in 1960s, then, the Nifty 50s of 1970s, dot-coms, cryptos, and now AI. Third thing, and this is something we have talked about earlier, but there were some questions earlier on this one, on leveraged funds and ETFs. Again, how many of you actually use leveraged funds? Yesterday, one of my friends sent me a screenshot of TQQQ, and I'm like, people still love using leveraged funds, and not just, because the lure of using leveraged funds is so attractive that, hey, if you can get the direction correctly, you'll make it twice, 2x, 3x, and all that stuff. I see a couple of comments, so let me go through that, and I'll come back to leverage funds. Can you please touch on how option selling impacts positively or negatively due to dividends? Okay, yeah, we will talk about it. Sam said, quite honestly, ChatGPT is not great. Some answers are Bing, if not on Google search. Yeah, ChatGPT, it still hallucinates because the whole large language model is based on probabilistic way of determining an answer and not a deterministic way. So if you are asked a very specific question that has mathematically one answer, you'll see ChatGPT might hallucinate and try to give, you might end up in a wrong answer. But if you ask something to draw an inference out of a paragraph or give you a context, it will be able to draw inference. But Sam, this is just, we are in a 0.1 version of AI and LLMs, right?
Vivek,
yeah.
Specifically, I asked it who is San Francisco mayor's husband, and it didn't come up with anything. Google, I don't think, came up with anything, but I threw it in Bing because I already knew the answer, but I wanted to see what they had to say about it. That I thought ChatGPT was everything on the web.
So ChatGPT, if you're using the free version, which is 3, does not have any data beyond 2022. So
no, the data is fine. The mayor was married the end of 2020, so it's within the time frame.
Okay. Yeah, I mean, Google should be able to do that. I don't know why ChatGPT didn't do it, but in any case, it does hallucinate. I mean, I asked it to give me a financial metrics for, was it Google or ASML for last 10 years? It gave me some of them were correct and some of them were incorrect. So I'm like, I can't depend on it. It does hallucinate, but all I'm saying is it is in a 0.1 version of AI, usage of AI for our day-to-day work. It's going to take some time before it become accurate, and we'll start using it as, like, now we use web, right? Now we use Netflix or any of the activities that we do on web. So I'm pretty bullish on usage of AI for productivity and for future, but I think right now it's in the hype cycle, so which will die down at some point of a time. See, Ramesh, what matters is my portfolio, but then I wait for a couple of days. What goes up comes down. No sense in chasing, believe in 100% drip. Yeah. Wish BRKB offer dividend. Again, BRKB will not offer dividend because they know they can generate. And let me take a step back and maybe talk about why the companies, what drives the company's decisions to offer dividend. It's not that suddenly someone, CFO or a CEO will wake up and say, okay, let's give a dividend because that will increase our share price. That's not how it works. Dividend is a capital allocation decision by the company. Right? Company has got, generate some extra profits. Now they have some capital left with them. What can they do with that capital? Right? Eventually, the goal of any company will be to increase the shareholder value. Now, if you have a capital available, there are a few things you can do. One is you can use that capital to invest back into the company and grow the company, right? If you are a growth company, that is what I want the company to do is, guys, grow your business, build your, increase your R&D team. And again, I'm coming from a tech background, I'll probably talk more. My examples will be more related to the software companies, right? Increase your production, buy more machines, right? Capture the market, expand yourself. If you have a capital available, grow your business, because eventually, if I'm a shareholder, in the long term, the prices of my shares will be dependent on how bigger the business you grow. So either you can reinvest in your business, or you can buy, or you can acquire some other company, right? You can figure out, guys, I think we have well entrenched in our business, and maybe we can acquire some other company, right? Use it for acquisition. Third, you can actually buy back the shares. You could say, oh, my shares are right now very cheap, cheaper than the intrinsic value of what my business worth is. Market is not valuing our shares correctly, so maybe I can buy back the shares at a cheaper value than what it is worth. Number 4, I can't find any use of this capital. I have grown into my business. There's no other acquisition that I can do, and our stock is currently highly priced, like stocks like Nvidia. So there's no point in buying the stocks at a higher. I should buy the stock when it's trading cheaper. So I don't have any use of the capital. I can't figure out. I'm going to return it to shareholders by offering them dividend. So it's a capital allocation decision. Now, if you are investing back, if you try to take a route number 1, which is using that dividend to invest back in the company, you should only do that if you can generate the returns which are higher than what the, let's say, market would pay, higher than the SPY return. And Berkshire Hathaway, Warren Buffett thinks that Berkshire can continue to generate the market-beating returns, so that's why he doesn't want to return the capital back to shareholders, but use that capital to grow the business and generate much higher return than what shareholders could get in the market. Right? And believe me, most of the people, when they get the dividend, they probably would squander the dividend, use it for buying, whatever. And so rather than reinvesting and growing it in the market. So that's the reason why Berkshire Hathaway doesn't offer dividend, whereas he loves dividend. Right? So, but it's a capital allocation decision from the company. And that is when I see companies like, I think Nvidia has now saying they're going to do a $25 billion buyback. I'm like, what the heck? You know what your share price is? And the share buybacks are generally taken by company at the worst possible time frame. If you go back and look at the buyback history, most of the companies fail miserably in buying back the shares. So that's the worst capital allocation decisions most of the companies take. They eventually end up in buying the shares when there's a lot of hype in the market and the shares are higher than the intrinsic value. So why would you buy shares if they are priced at more than what they are worth? But many companies do it. All right, coming back to leverage ETFs, because the reason why I'm talking again, we talked about this, I think, a few sessions earlier. Also, it does have some use of it, but you should never inventory it. Means if you don't own it for more than a day, and if you think that, hey, tech is really overvalued right now, I want to buy TQQQ, which is short, I think 2x or 3x leveraged. Even though tech may goes down, even though stock may go in your direction, you could still lose money. Okay? And here's an example that I saw, and I think this has done much better job. So I thought than what probably I had done in a previous session. So if anyone of you are in leverage funds, understand what you're getting into. So let's go through one example. Whereas you have a index day 1, it is 100, and this is, and then day 2 it becomes 125, up 25%. Day 3, it is 90. Day 4, it is 103. So overall, it's actually up 3%, right? Your daily change is 25%, then falls down 28%. So goes from 125 to 90, goes up 14%. Cumulative change is eventually it's up after fourth day, it's up 3%. So if you are using leverage ETF, you should be up 6%, right? That's what most of the investors think, that if I have a leverage ETF, if it's up now 3%, if I'm 2x leveraged, I should be up 6%. But you may be for a rude shock, but because eventually it is actually down 15%. It's not up 6%, it is actually down 15%. So even though the stock moved in your direction, if you were long and bought a long leverage ETFs or any leveraged instrument, even if the stock moved in a direction, you could still end up losing a lot of money. And the reason is just a plain math. They do a daily compounding. So be very, very careful. And there are a lot of leverage ETF products. And if you're on a Twitter or if you're on a YouTube, you would see folks talking about, how you can use these leverage products to make 200% or double your money. Doesn't work out in the long term. That is why it should never be inventory. It should be used only for overnight purposes and not anything more than that. So I don't see why any retail investor should be using this at all. But if case you're using it, please understand what you're getting into. Another similar example on not a leverage ETF, but similar concept of daily balancing or daily compounding on daily basis, which is if you or ETF on a short, right? This is a short position, inverse ETF. Again, I know of even a fund manager because I went to a money show and I signed up for them, and they keep sending me letter. They are professional money managers, and even they pile up into inverse and leverage ETFs. I'm like, what the heck you guys are doing? So same concept, day 100. Okay, then it's down 20%, so it's 80. Then it's down 25%, it's 60. Down 8.3%, 55. Day 5, back to 100. So if you are just having inverse ETF, right, or if you are having just a long stock, you started at $100, you are ending at $100. If you have a short stock, you started at $100, you're ending at $100, right? This is a short position, which means it's just your regular short position, not on a daily basis, not daily cumulative. But if you have an ETF shorts, it's not leveraged, but ETF, it's a short ETF, but then looks on a daily basis, you actually end up 60% bad, right? 70%. So you started at 100 and you end up at 29.5. So if you're using any of these daily, I don't know what's the exact term, it's called daily compounding or daily. So basically it levels after end of each day. It looks at how many percent the stock has changed and its value changes accordingly. So in this case, it started at 100, stock fell down 20%. You have a short ETF increased in value by 20%. Stock fell down 25%. It increased in value by 25% to 150. Stock is down 8.3%. It further increased in value. Now stock is up 81% and it lost. It's now down 81%, means it's down up to $30. So in any case, we are picking up either inverse, with even in any case, if you're picking up anything which is being measured on a daily basis, understand that you could be in for rude surprise. Leveraged one, similarly, it's really bad. I mean, it amplifies the negative impact. So want to get this out because we have discussed this earlier also. I also wanted to share an example that I came across in the book. Now, even after this, you want to go and do leverage. Yeah, that's a gambling chips, right? Go ahead and do, with whatever money that you won't mind losing. Okay. Anyone out here has a good story on the leverage funds? I haven't heard any, but do let me know where it has helped you and how it has helped you. Okay, let's talk about a little housekeeping. I've become a little more active on Twitter, or I should say X now. I think I started on December, but now over the this week, became more active and a lot more engagement over there. And I think I can reach out to a lot more people in helping them out. So it's up to you for on Twitter. We can have a lot more engagement during the week. This is my handle. No pressure if you want to follow, up to you. But yeah, I've been having a lot more fun on Twitter nowadays. Like I said, no meeting next week. I'll be traveling, so we'll resume our discussion on September 9th. Okay. With that, let's get into the macro. Today, not today, but the last week, only macro stuff that I saw was only Nvidia, right? The whole world looked like whole world around investing or the stock was the only thing was Nvidia, as if that was the most important company on face of earth. And we are reported results. And gosh, before that results, as you can see, everyone in Wall Street was rushing to raise its price target. The ones which are the most ridiculous ones I saw was Rosenblatt is giving $1,100. HSBC is up to $800. Baird is up to $750. Right? No one wants to be left behind. And I mean, if you are a Wall Street firm being paid millions of dollars by your clients, and if you are valued Nvidia at $250, you can't save your face if Nvidia has been now trading at 400, 450 or whatever, $500. So not the first time we have seen the same stuff during Zoom. Everyone rushed to, I think probably I've seen it in every stock. Analysts will follow the price and will figure out a way to justify the price. Right? Very few analysts stick to their own thesis and the price derived from what they think the business is worth. Most of the analysts will just chase the price and then come and justify why it would be now 600 when it is 500. When the stock was 400, or they reported results in Q1, the previous week, the previous one, Q1, they blew the expectation through the roof, and no one raised the price target to $600 at that time. But now the stock has moved up to 450, 500. Everyone is rushing to upgrade the price. So be very, very careful when you see these price targets. Right? Each one is playing a different game. They have to save their face. We don't have to. So you can make your own judgment. You are not answerable to anyone. So you can make your own judgment. Is it really 750? From my perspective, I don't think so. But in the short term, market is a voting machine. So more people vote for Nvidia to be 750, the stock will stay at 750. But long term, it will be a weighing machine. So it will back to what it really is worth for, right? And that price discovery will happen it'll take some time. So what NVDA did, reported results, which were not surprising because they blew the Q1 through the roof. Same thing they did with Q2. Record revenue up 88% from Q1, sequentially up 88%, and more than 100% from a year ago. Data center is what caught everyone's fancy because this is where all the AI chips are going in. So NVIDIA has data center, visualization, gaming, and autonomous driving. Right? These are the four bigger revenue segments for NVIDIA. Data center is where all your AI models are being run. So that's the biggest part of their revenue. That's up 141% from last quarter, up 171% from a year ago. Right? Few stuff that Jensen Huang says, the race to adopt generative AI is on. Everyone wants to adopt generative AI. Right? When I say everyone, not just every company, but I think even the sovereigns, they want to secure NVIDIA chips, H100. Middle East wants to secure the chips. China wants to secure the chips. Startups want to own these chips. Of course, the big hyperscalers like Googles and the Amazons of the world, they want to buy these chips and all that. And it is showing up in the results, right? But the bigger question is, how long can this continue? Will it continue to see the same growth for quarter after quarter? That's the biggest question. My perspective is, this will, right now we are seeing a lot of the demand has been pulled forward. And today, every company is right now figuring out, let's build our generative AI and set up our LLM infrastructure. We'll figure out how to make money out of it later. And this is the same stuff that we have seen time and again. .com days, let's build this website, we'll figure out how to make money later. And build fiber optic capacity, we'll figure out how to make, and those companies have gone bankrupt. I'm not saying Nvidia will go it, because Nvidia has a magic touch. They always turn out to be at the right place at the right time. But to me, it looks like a lot of it's pulling forward a lot of demand. So it may not be sustainable, let's say 2 years, 3 years down the line. Could be wrong, but that's what, to me, it feels too frothy right now. I say a question, how can TSMC meet the demand? Exactly. So NVIDIA buys their chips from TSMC and Samsung. And if you really think NVIDIA can deliver all these chips, then maybe I would rather be bullish on those, TSMCs and the Samsungs of the world, because they will have to build those chips. I didn't see in the TSMC result that they've been so bullish about, next few quarters. So we have to see. Again, there is, I want to look at like bull and the bear case both from NVIDIA perspective. Bull case is obviously everyone wants AI. Bear case is, I don't know how long it is sustainable. I feel a lot of demand has been pulled forward. Number two is, if this business is so profitable that NVIDIA can command a premium, I mean, all these hyperscalers probably are anyway and will continue to build their own chips. They may not need NVIDIA's chips for running their AI workloads. Right? If it is a really very high margin business, it will be competed away. There will be competition that will come in. Right? Maybe someone will develop a software which will make the overall, at the end of the day, if I'm a startup wants to run an AI model, I really don't care whether it's a better hardware or better software. All I care is that it does the job quicker. And today, the job quicker is being done by the AI chips. But if it becomes super expensive, competition will come in and probably figure out how, to reduce the cost. Maybe some new development software side could happen. Again, I don't know, but I can't imagine that this moat will stay, with Nvidia for years to come.
Vivek, may I say something?
Sure, go ahead.
I agree with you, and I think it's very frothy, but just one thing about your analysis. TSMC might not be getting all of the same jump, even though Nvidia pays them for the chips, because it's not so much the volume that Nvidia is selling, but the profit margin makes it super interesting, because on their H100, they have more than 90% of gross margin. They sell their chips actually more like 50 times the price that it costs them to make, which is, well, yeah, operating income. But I just mean the fact that they have, their new chips are being sold so expensive compared to what it costs to make, which is a very interesting proposition for Nvidia and not so much for TSMC. I just wanted to add that as a little bit of an additional element.
Yeah, no, thanks for the additional color. And this is what I'm saying. If who said that? Like Jeff Bezos said, right? Your margin is my opportunity. So eventually, this margin will be competed away. It might take some time, might take a year, 2 years. I can't imagine Googles and the Amazons of the world, Apples of the world, allowing Nvidia to continue, skim them with such a huge margins, or that other companies are not eyeing at the same sector and say, gosh, it's such a huge margin business, we need to get into this. So it will be competed away. Nvidia has got a lead, but if it's such a huge margin business, they may not be able to sustain the same lead. Right? So that's a challenge. If the sector is really, really very profitable, a lot of companies will try to get into that sector. And today, valuation has assumed that not only Nvidia has got everything, all the business of around AI, but they can find more businesses which are as big as AI opportunities that we don't know about it right now. Fine, if Nvidia is able to do that, and I think they have done it, like I was saying earlier, they always find them at the right place, at the right time. When crypto came, Jensen Huang was equally positive about that in terms of the opportunities ahead. Gaming, earlier it was gaming, then crypto, they somehow are able to pivot it. But again, I don't think they can enjoy these fatter margins. So at this valuation, at least I am not intending to go ahead and say, I'm not intending to put my money behind Nvidia. Let them prove, let them find another market, which is as big as AI, because that's what the share price is kind of a valuing it at. That's the only thing that I want to say. But good. Thanks for adding that additional stuff, saying it's not the number of chips, but it's the margins that matter, and it does show up here, right? It's like operating income is up 1,000%. Okay. So cool. AMD is in use for developing their version. Yeah. So and of course, Amazon, Apple, and Google's and the Facebooks, will all be building their own chips. Will be designing their own chips. I don't I can't imagine them sitting there and let Nvidia make such a huge profit margins. Yeah. But short term, yeah, stock can go wherever it wants to. Okay, all right. So outlook is expected to be $16 billion, whereas the market was, I don't know, market was about 13 or 14. I don't recall what the market was expecting, but their next quarter, they're expecting 16 billion. So this was a complete blowout, right? Market was expecting around 11 billion. They guided around 11.5 billion. They did 13.5, up 171%. So with these, and I'll skip, the details. A lot of ink has been spilled on Nvidia. I don't have to spend any more time on this one. But looking at these results, anyone could imagine that the share would have just blown out. But eventually we saw that Nvidia just closed with a whimper. Right? 47 cents. It closed up just barely, up. So what gives? All that was already priced in, right? You would expect someone reporting such a stellar result, stock to be up 15, 20, 30%. And options market was already priced in. Options were pricing in almost $50 move. I think I tweeted around it, or maybe we were in a Slack. I just mentioned it, saying options is pricing almost $48, which is 10% move post earnings. And the options were very expensive. So whether you were bullish or bearish, I think both got killed in Nvidia. Because, once the volatility dropped, stock didn't move much. The options probably would have expired worthless. Right? So, and the reason is, if you look at overall this whole quarter, market has been very tough on companies. Right? And this comes from a Bloomberg chart around S&P 500 stock reactions. Right? If you have beat the market on an average, stock has done nothing. Right? It's not that you met expectations, but even if you've beaten the expectations, market as overall has done nothing. 0% on an average, right? And I agree there will be outliers in an average, but this is the data that we have. And if you have missed EPS, you're actually down, which is understandable. But the fact that you have beaten expectations, market still, it's okay. Because we've been pricing in all these right from the start of the year, right? QQQ is up, what, 37, 38%? A lot of growth has already been priced in. So even though the results are great and up 100%, stock didn't react to it. And all the options, and last I heard was, is there a negative squeeze going into Nvidia? Because looks like after that, where did Nvidia close? Oh, now it's at 460. Right? At some point of a time, it was like 500, 510, not banned to 460. Again, from my perspective, I think it's still forward P is 28. It still feels too high. Price to sales is 35. So I'll wait and watch what they do. So that's on Nvidia, because that was the main macro news. The other macro was around Mr. Powell, Jackson Hole. I thought that was nothing burger, so won't spend too much time on it. Again, the same story that we have heard in every Fed meeting, will be data dependent. Only one thing which I think market was wishful thinking was, some economists have come and talked about, maybe Fed should have a 3% target of inflation rather than 2%. So there was some chatter around maybe Fed could give up its 2% target and say now our new inflation target 3%. But now that didn't happen. So same narrative from Jerome Powell is 2% is and will remain Fed target. We will do whatever is required to meet our dual mandate of maximum employment and price stability, and probably maybe one more hike, then we may be done with it, so on and so forth. Only thing is, market started pricing in one more hike of 25 basis points, maybe in November. But overall, nothing burger. Market took some time to absorb the news. It fell down initially, then came back up. So not much of a change. So that means market is up, what? SPY is up 15.5%. Still a great year so far. Can't complain about it. And QQQ is up 38%. Now, generally it is said, and again, 1 month doesn't define the overall trajectory, that September is bad months for stocks. So if you are still holding it, what can you do for holding the stocks? Number two is, while the overall indices have been doing great, there are some stocks that haven't performed. And that brings me to a topic around cost basis reduction. I saw some tweets around this, right? Disney shares are now at the same price they were almost 10 years ago in 2014. Right? If you invested in Disney in 2014, you have made no money. And you would actually still be in loss. So let's go to Disney and see what this has done. So let's go to Disney. Let me pick a weekly and see if I can get back to 2014. Right. So it's back here at $83, where it was last around here, 2014. So even though I say that I'm a long-term buy and hold, I used to be long-term buy and hold, but over the last 6-7 years, ever since I started getting good option, became buy, hedge, and hold investor. Now, if you were one of Disney investors and you still like the company, of course, companies have their own ups and downs. Businesses, they figure out new business models. But if you've been holding from 2014 onwards, and that's not, that's almost 9 years. And it's back to where it was 9 years. So I saw on Twitter a lot of cash. What can you do if you're holding Disney? This is just an example. Reduce your cost basis. That brings us to our first topic of cost basis reduction. I can't control stock price, whether you like it or not. You can't control stock price. Only thing that you can do is two things you can do as an investor. One is your position size. If Disney was 50% of your portfolio, you're in a tough spot. But if Disney's position size in your portfolio was within the limits, then yeah, Disney hasn't returned anything, but it was 5% of my portfolio. So that's still okay. Right? It's only 5%. And I see a comment, what hurts is no dividend anymore. Yeah. After 2020, they stopped giving dividends also. But even if you go back, and I saw another tweet that even if you go back and add all the dividends, you're still not making much money. Okay. So I can't control where the stock will go. Only thing I can control is two things. One is my position size. Other is the cost basis of the stock. Okay. So as a long-term investor, our focus should be on reducing the cost basis. How can I keep nibbling upon the cost basis of the shares so that if I own it for free, then it becomes much better to hold the stock if I own it for free. Right? Then $83 is purely profit. if I can own it for free. Or, I mean, in that case, you're playing with your house money. I mean, you will still want the stock to go higher. Don't get me wrong. I'm not saying that if you own it for free, you can just ignore it, but it becomes much better to hold it. And if Disney comes back, you're there to enjoy the gains, right? And the reason you're holding it because, hey, I think Disney will come back. Not, I mean, you think as an investor, Disney will come back. But if you're not, if you're bearish about the Disney's prospects, then I think you should just sell off your stock. Then we shouldn't be even complaining about, where the stock is right now. So what can we do to reduce the cost basis? One is, and this is where many of the retail investors do, is, gosh, I bought the stock at 100. Now it has 80, 83, let's say 80. Maybe I'll buy more. But that means you're investing more capital, right? This needs more capital investment. It means now the stock really, really has to work in your favor. Otherwise, you might end up losing more money. This is sometimes called as throwing good money after bad, if Disney turned out to be the bad stock. I'm not saying it is. I don't know. I am still hopeful that Disney will turn around their business, but I don't control, Disney management. So, yeah, you could do this to reduce your cost basis, buy more at 80, but then it's like I'm digging myself a little more into the hole with the hope that someone will come and fill up that hole later on. Right? It needs more capital investment. Other thing is, if the stock had gone higher, say if you bought it at $80 here and you sold some at 2020, at $100, 140, the remaining shares, you took some profits out of it, and the remaining shares, your cost basis will be less, right? This is one way of doing it, but then you are actually giving away your shares. And many investors get into that seller remorse, or could have had FOMO and saying, gosh, if I sell my share stock, what if stock continues to go higher? Right? So this is a way. Ask the company to pay dividends, right? Because you get dividends without any additional investment. Though technically, I would say that it does not reduce it does, okay, it does reduce your cost basis, but technically the stock price also is supposed to fall equivalent of the amount of dividend paid, but it does reduce your cost basis, right? You bought the stock at 100 and company gave you $1 of 50 cents of a dividend. Now your cost basis is now $99.50. But majority of the company that I own, or if you're a tech investor, growth investors, they don't pay dividend. Fourth is, I think, was it Geraldo who brought up this question around lending the stocks to your broker to earn income on it. Now, not all brokerages do it. Number two is, I think, you have to have what HNI or a high net worth. Like this is what most of these billionaires do it, right? This is how Elon Musk does it. This is how he sponsors his lifestyle. Is he's got so much of Tesla shares. They basically take a loan against those shares and use that instead of selling the shares and getting paying capital gains tax. Now, as a retail investor, I don't know what avenues do we have for this one. If anyone else has used it, feel free to pitch in and share. Have you been able to find a way to lend your stocks to your broker to make an income?
Hey, Vivek.
Yeah.
So I actually heard that there are some, like you said, some brokerages, they do this type of lending. I hear that you need to have a minimum of 100K in the portfolio, yet they will do this type of lending using your portfolio as collateral. The exact brokerages I don't know yet. I can do some research and find out and share with the group.
Sure. Yeah, that'll be helpful. Yeah, you need to have, I mean, they won't do it obviously if you have a smaller account, but the way brokerages do it, because if someone else is shorting the shares, brokerages have to find a share to allow the other party to short the share. So you can actually lend your shares to the broker. Now, the exact mechanics of how that works is something that I've not explored.
Okay.
Now, and number two is, what's the minimum number of shares you need to have it so that brokerage will even entertain, borrowing shares from you, because there may be some cost involved and all that stuff.
Right.
And when broker, let's say if I'm shorting a share, broker will charge me the borrowing cost for allowing me to short the shares. And what they do is they will borrow it from someone else and they'll pass on that, whatever, some portion of what broker earns to the one who is lending the stock. So that's how you could actually make some money while you are holding the stock with you, and you want to hold it for a long term anyway, and lend it to your broker so that they can then have the stock for someone who's trying to short the stocks.
Right.
The mechanics, I don't know.
Would you say that brokerages for them to lend you money using your portfolio, would your portfolio have to be more concentrated on blue chip stocks because they're less at risk of being margin called?
So margin called, so again, I don't know the mechanics of it because I've not done it, but generally margin call would be dependent on your portfolio value. And if you have a lot of shares that are very volatile, and let's say if those shares go down 20% in a day, if they are, thinly traded, if they are small caps, small to medium caps, and these things could happen, then you are at a risk of getting margin called. So that's why you might generally see people talking about have a big blue chip, because those stocks don't fall down 20% in a day.
Right.
But the new medium caps, small caps, or a newly IPO'd companies or growth stocks, like Domo, fell down about 40% after their earnings announcement on Friday. And you imagine your portfolio, if you're having large chunk of Domo, suddenly you see your portfolio value going down, and then you end up under margin call. But margin call generally happens if you have borrowed money from broker. Okay.
Right.
So I just, but this was a different wherein we are giving the shares to the broker so that they can then lend it to someone else who's trying to short the shares.
Thanks, Vivek.
Okay. See, Prem says margin on the portfolio is getting money from the broker. Yes. So I borrowed money from M1 Finance with my portfolio as a collateral, and they pay interest on and pay interest on money borrowed. Yeah. So that's a like regular buying, borrowing money on margin, and then they use your portfolio as your collateral. Example of what Geraldo is saying is PAL at shop, minimum 100K. Yeah. So the other last step, which is what I follow, is basically selling options to generate income. And that is my preferred way to do it. And so I actually responded to that tweet and like how it helps. So this is my own personal one, right? So I've been buying Disney shares since May 2020. I bought it at $140. I bought it at $100, $110. I bought it at $90, or probably bought it at $80. I have to go back and see what were my different purchase prices. But overall, my average buy price is 101. Right? So if I'm sitting on 101, oh yeah, I'm at huge loss right now. But I've also been selling premiums and when I say sell premium, it could be covered calls, it could be all sort of stuff, right? Put spread, instead of buying it directly, I might have sold a put spread, and when the stock fell down, of course, then I had some cushion that would have reduced my cost basis. Today, my cost basis is 76. So I'm like, either we can complain, or we can just reduce the cost basis, figure out whichever way. I don't care. I mean, whatever works for you, right? All I want to share is the concept of cost basis reduction is, as an investor, is not generally talked about, but it is very, very important. And that has helped me to stay longer in the market. Otherwise, at this point of time, panic starts to set in around, gosh, I'm down 20%, right? I'm down 30%. But if you know that you can always continue to nibble on and, chip in and start reducing your cost basis, that I know, like, give me 4 years, 5 years, I can bring down my cost basis to 50%. And anyway, when I'm buying the shares, like I said, I buy minimum for 10 years or ideally forever. And then the way I can still go through this volatility is trying to reduce the cost basis. So if you're not managing your own money, or if you're looking for a financial advisor, I would say one question that you should ask your financial advisor is, of course, there are a lot of other questions that you should ask, which is, how do you make income, right? Is it based on asset under management, or is it a fee-based advisor? Do they sell a particular, do they have a tie-up and sell only particular funds or not? So you understand what's their, are they fiduciary or not? You need to understand what's their incentive. People will behave what their incentive is for. So you need to understand the incentive. But one question that you should also ask is, how are you going to reduce my cost basis? And if your advisor is like looking at a deer in the headlights, you should go for a different advisor. Otherwise, many advisors might just be a feeder funds to other mutual funds. So then, hey, I'll buy that SPY myself or other mutual fund myself. Why do I need to pay another % to an advisor? So one question, if you're going for a financial advisor, always ask them, great, I'll give you money. And most of the advisor will put in a market, mutual funds which generally will mimic the index funds. One question you should definitely ask them, how are you going to reduce my cost basis? So always, now, it doesn't happen in a day or a two, or a week or a month. It took me 4 years, right? 2020, almost 3 years, little more than 3 years. So you may not see the impact of it. And that's the one reason why most of the people don't do it, because it's a work. It's a work to do this, right? And there is always not a risk, but apprehension of, what if this get called away? What if this will fall down, right? So it's a little more work than just buying an option. But it's an optimal way to continuously reduce your cost basis. So this is what worked for me. And this week I had another example. And I'll come to your question, Sachin. Let me finish this topic. Is Blackberry. I saw Blackberry is now being acquired. Or not being acquired. There was an interest from Blackberry. Blackberry acquisition. Right, Veritas in talks to acquire Blackberry. I don't think they have shared what's their at what price would it be, but the fact the stock is now up 19%, valuing at 2.8 billion. So I'm assuming that market is efficient, that whatever Blackberry is trading right now is probably the price at which they may want to acquire, which is $5.23. Now, I've been in Blackberry for almost 4 years. And my average buy price is $5.47, because Blackberry has also gone through this meme mania, So I got into BlackBerry in 2019. My thesis was different, more from their acquisition of Silence. They're trying to pivot it, so it was more of I would say a cautiously speculative play on restructuring of business, and then they pivoted their business to cybersecurity, then to automotive. Their QNX operating system is in like few 100 million cars and all that stuff. So my idea was maybe 10 years, give or take 10 years, 10, 15 years, if they're successfully able to pivot into a new segment of cybersecurity, then I do want to own this share. So that was my thesis behind why I started, picking BlackBerry. But I could be wrong, right? So continue to sell option premium. Cost basis 547, option collected 433, net cost basis $14. Now, if this acquisition goes through, then there is no further upside for me, right? This is whatever, I'm assuming if this is a price, then eventually if I just bought and held the stock, I'll be at a loss. And this is why I always come and talk about why we should focus on reducing the cost basis. You never know what could happen in the market. There are things that we can control. There are things that we cannot control. You can control position. We can control how to reduce the cost basis and stay in the market. So even if now it gets called away at $5, well, my cost basis is near $1. So I'll still be okay. So that's understand. I mean, that's why I want to focus on. I do focus so much on a cost basis. Is let me make sure that I can take all the money that I've invested. I can take all that out, and still hold all the shares. My idea is to just generate income through options so that I don't have to sell the shares, and more the more the cost basis I reduce, lesser is the risk. Right? Now my risk is like $0.14. It goes to zero. Yeah, I lost money, but I didn't lose $5. I want to hear what are other methodologies that you guys have used to reduce the cost basis. Anything else to share? So I moved from being a buy and hold to buy a reduced cost basis, so that then it helps me to hold and go through these periods of 2022 and 2020 March and all that downturn, because I know given enough time, I can probably own the stocks for free. And that is what actually eventually we want to do, is own all the stocks for free. So that's on cost basis reduction. And let me see Sachin's comment. I have a question on how to manage a position. Bought Nvidia at $80 last year. Immediately sold 150 covered call for Jan 2025. This runaway not able to roll beyond 165. Any other effective way to manage it? I would start selling put at a strike to avoid assignment and collect premium. Yeah, so that is one way, is to sell put and continuously sell put. And there are two things you can do. It looks like you already tried to roll it. Maybe try to roll it out further, but I don't think there may not be any more options beyond 2025 on Nvidia. Right? That's probably the last what do you say, the expiration period. Yeah, 19 December 2025 is the last expiration period. So only thing you can do is to maybe sell a put against that. And let me see if yours is what expiration. I just want to see how much is extrinsic value left. So you sold 150 covered call. Sachin, what's your expiry period? June, December, Jan? Let me put June. Jan, okay. So Jan, so it's right now it's probably way in the money. 150. No, you still have almost $16 of expiration. Oh, sorry, extrinsic value. So probably not at a huge risk of getting called away. So you may, yeah. So this is anyway behaving your 100% like a stock. What you could do is maybe start selling puts for shorter expiration period. Maybe sell a put for 20th October, right? Put for 20th October and collect this additional premium. Now, your question is, now I do want to talk about this. I'm not getting into the details of, you know, how effectively you can, and that's why I said it does involve work, right? Because now you sold a covered call. If I were at your place, and because I've done the same mistakes, right? And then I learned. Now, for any of the individual stocks that I want to hold in my portfolio for long term, I'm not selling. If I have hold 100 shares, I'm not selling one naked call. What I'm doing is rather selling a call spread. So that if, and we have seen this during the whole, I learned my lesson during the meme stock mania. If the share or the, you know, continues to go and becomes bonkers and blow through the roof, sure, I will, you know, if I have a call spread, I'm still there to enjoy the upside gains. Okay? So if you were at 80, let's assume right now, let's pick any stock. Let's pick AMD. 100, but let's say I own AMD at, I have only 100 shares of AMD. And this is my overall position, and I own it at, from a simplicity perspective, $100. Okay, if I own AMD at $100, and I'm bullish on AMD, but I do want to nibble and on the, and to reduce my cost basis, but I know that AMD could be, you know, this whole AI mania could continue for longer than what I expect, and then AMD could continue to go higher. So my first preference would be, probably I'll come here and say up almost 25%. That's a decent enough, or maybe 20% gain. And then maybe, what am I sacrificing? I'm sacrificing only 40 cents premium, right? But this does give me an upside to continuously play if market goes crazy on AMD, right? So yeah, if it stays between 120 to 140, okay, I won't have any upside gains, but that's a risk I'm taking, is if it becomes double, right? I don't want to be, what it says, you lost on all the upside gains. And there's a question somebody actually asked me on Twitter saying, what if Disney could have, instead of going down, if Disney could have gone, you know, way up, do you lose on the upside? No, you don't if you structure your trade accordingly. And this is a lesson that I learned, you know, in my earlier career, is if the stocks that I'm really bullish about and want to hold for a long term, I'll probably sell a call spread. Or maybe I'll sell one call, but hold 200 shares of AMD, and then I maybe just sell one call, right? So that at least I still have half of my AMD shares to enjoy the upside. There is always, as you guys know, there is always a trade-off, right? There is nothing without risk. So you have to figure out what trade-off work for you. So when I've been talking about Blackberry, right, or Disney, it's not that I have sold either covered calls against all of my shares, right? I've been selling covered calls only against a portion of the shares that I hold. And this is so remember we talked about a concept of coffee can portfolio. And after that talk, what I've mentally done is I looked at my portfolio, and something that you could also do is, and then I say, okay, if I have 300 shares of this stock, how much I want to hold and put it in a coffee can portfolio so that I don't have to, I will never sell this. Let's say that number is 100. So then I say, okay, then I can sell 2 covered calls. Or let's say if that number I come out to be is 200, then I say, then I can sell 1 covered calls. If a stock like Blackberry, if I own 500 shares, then I'll say I want to hold 300 shares, put that in coffee can, then I know that I can sell 2 covered calls. So that if this Blackberry get acquired at double the price, I can still enjoy the upside. So that's how, figure out how you can make a decision. If I have 100 shares, then I say I want to, that's the case with Nvidia, right? I had 100 shares, then I say, which was where I sold half of my position. I don't know the number of shares, but example, if I have 100 shares and I want to put 15 coffee can, then I'll never sell a single covered call, rather sell a call spread and say, if it continues to go higher, then I will only gonna sell a call spread because I still want to, I'll probably sell the 50 shares and close the call spread and still retain the other 50. So that's a decision making you have to do. There is no free lunch, and that's a little more involved work. But if you can do it over and over and over and over again, you should see a substantial reduction in your cost basis. And that's my target, is how can I reduce the cost basis so that I own the stocks for free? Does it make sense to sell at lower? I see a question. Does it make sense to sell at lower strike for lower premium rather than spread? See, I would have said yes if you would ask me 5 years ago, 4 years ago. But I've seen some of my stocks sometimes gone crazy. Then I repented I have gone up 50% higher. So I'm assuming you mean to say instead of lower strike means upper strike, right? That you go further out in your deltas at lower deltas, and then you sell a covered call. Then you sell a call, right? It's say instead of doing 120, you could say maybe I'll do 130, which gives me 30% upside. But I've seen some stocks, take an example of Nvidia. Nvidia was like $400, $500 billion company, and the stock goes up 30%. So over the last 4 or 5 years, I've learned my lesson and saying individual stocks can go up 40%, 50%. Even the ones which are with the higher market caps. It does happen, always have been happening with the smaller and mid cap, but even with the higher market caps, I'm seeing where the stock could go up 30%. And then I became wiser and said, if I want to hold the stock, then I don't want to take the risk and do, and let's say, naked call at 130. In this case, even still, I'll go further down. I probably still do 130 and 150. Yeah, I'm sacrificing 20 cents of a premium, but that does give me an opportunity to enjoy the upside gains. If let's say Nvidia comes and say we want to acquire AMD, these things can happen in individual stock, acquisitions can happen, and they are willing to pay 60% higher than what the market price is. So that's the reason I would rather go with a spread and not go with a call. I've done those with, look at what happened to Meta. Meta is up 128% for this year. Nvidia is up like 200%. How on earth you could have imagined that Nvidia could be up 200% at the start of this year. There is no plausible scenario. And why about us? I mean, no one in the even Wall Street would have imagined that Nvidia will be up 220% at the end of a year. And if you had sold a call, you bought it, let's say, wherever, this is start of a year, you had 130, you might feel pretty confident saying, maybe, you know what, next year, 100% gains, I might want to sell a call at 260. You know, it's such a big company who, you know, 100% is good enough. And right now, you're probably having a seller remorse. So I don't do that. I rather will sell a call spread, sacrifice a little bit of a premium, but still have that lottery ticket available for me, and still reduce the cost basis. So that's on a cost basis reduction. And maybe, you know, we can talk about various ways of, if you're holding a stock, you know, call spread, and combination of call and a put spread, and all every strategy that helps you to just get the more premium for the stocks that you want to buy and hold anyway. Cool. Any questions on cost basis reduction? We have now 30 minutes. I want to now jump onto the BVP report. No questions? Cool. All right. Okay, let's finish the macro level. Sector-wise, not much change. I mean, if you look, the worst performers are healthcare, consumers, staples, and utilities, because these are considered as bond proxies. I mean, stable one, you can get good yield from them. But then if the treasury is yielding more than 5%, then who wants to be in there? So that's why these are like right now unloved sectors. But if treasury yields start to go back down, these companies or these sectors which provide some yield probably will start to go up. Fear and greed index, still, market is not pricing in doomsday. We're still in a neutral category, which is fine. I think last week also we were the similar one. My buys and sells, again, SCHD and SE, little bit of again, you know, opened up positions. Always buying. Right? I mean, of course, when I sell the stock, I also come and talk about it. But no sales this week. Bought SCHD and SE, and will continue to, you know, reduce the cost basis of these. Okay, we'll skip this if time comes. What is SE? That is C Limited. So C Limited is it's a e-commerce gaming plus payments platform in Southeast Asia. Bobby, again, for me as an investor, I want to go and look at why that is an interesting stock. Okay, that's what I was trying to answer. I want to go and look at where on the world are the similar players like we had Amazon in US, right? So building position, because e-commerce will continue to grow, online payments will continue to grow, right? That's the nature of the businesses. So, and I've done, I mean, Mercado Libre is probably my biggest one, which is Latin America, does the same thing what Amazon does. And when it comes to Asia, they got C Limited, which is basically e-commerce payments platform play, plus they have a gaming business also, right? This stock was very richly valued during the COVID. Everything that had to do with online gaming and e-commerce So I had it on my radar for quite a long time, but I was never able to pull the plug because the valuation was extremely, extremely high. So I started building position, I think, was it maybe earlier this year or last year? I think I started buying it when it was 60 and then reduce the cost basis. I think right now my cost basis is at 54, 55 in last 3-4 months. It fell down, but that's okay. I still want to hold the shares and continuously reduce the cost base. So the play is e-commerce play. Another one which is focused on South Korea is Coupang. I hold it. Another one which is focused on Africa is Jumia. Stock hasn't done well, but again, I'm looking at 10-year of holding period. Stock is down, what, 85% from my buy price, but my cost basis is 50% of what I paid for. So I'm still down, but 50% less, I would say. But yeah, these are what you call as 10 years down the line, it pays off, it'll pay well. If it doesn't pay off, it's a small portion of a portfolio. Position sizing is okay enough that it becomes zero, it'll still be fine. PE for SE is around 80. Yes, because it's hugely in a growth mode. It's from an earnings perspective, it's not earning much, but so let me go back to SE. The reason why I started to build position in this is when they started to focus on cutting the cost drastically at the start of the year, right? So that is why I want to own it. So if you look at a forward P, so this is your last one, but forward P is around 30. Still expensive, but I don't think you can, any one which is a little more growth company will be expensive. Now, the recent issue that they have had with the decline in their gaming revenue, because India had actually banned their gaming app because of India banned all the Chinese gaming apps, and SC has some Chinese back investors. So they banned their gaming also. But again, from a long-term perspective, I'm looking at their e-commerce and payments platform, which has done good. Number two is they're focused on reducing the cost and be better in terms of their margins. And if that means not paying bonuses to their execs. So there is a little bit story around it, and I like that. That's why I opened a position on this one. Now, it is very, very important for you to understand when anyone, not just me, anyone talks about, hey, I own this. First question you need to know is, how big is a part of my portfolio, right? It's a very different conversation if I own 10% versus 1%. So again, this is a very small portion of my portfolio, and I'll probably build it. If I see company, doing the right things in future, then I'll add more. But at some part of a time, you have to bite the bullet and say, okay, when do I, initiate it so that it's on my radar and I continue to reduce the cost basis. So I thought instead of buying at 350, I would rather buy it at 60. All right. Any more questions? Otherwise, we'll jump onto the BVP Cloud 100 benchmarks report. So this is coming from Bessemer Venture Partners. Every year, they look at the cloud companies, their valuations. What do they see as a VC? Right? What's happening in the cloud businesses altogether? Right? So for the first time, actually, the value of all the cloud companies in aggregate contracted. No surprises here. 2022 was pretty bad. And when they say there's value, basically the value means the market cap, not the value of the business that they're generating, but basically the market cap. Either if they're I mean, these are probably are all private listed. So whatever their private valuation is, which itself is sometimes weird, but it is what it is. So the aggregate value actually contracted. And last year, right, to the average cloud 100 valuation was $7.4 billion. And what's that? The headwinds in 2023 has made the aggregate value to 654, means 100 top 100 companies overall value is 654 billion, which is down 11%. Despite this bleak backdrop, AI has emerged as shining light for the cloud ecosystem. No surprises at all. OpenAI not only made the list for the first time, but also replaced Stripe in earning the top #1 spot on the list. Stripe has been #1 for 3-4 years. Right? Hugely, richly valued company. At some point of a time, it was what, $90 billion. Then I think it probably now 40. Databricks is another company making big investment into AI, also moved into #2 spot. Yeah. Now, I also heard that Databricks is also looking to raise more money. Okay. So everyone is talking about AI. Even the company that I work for, we also released AI portion of our website. I'm like, what the heck are we doing? But looks like if you are a tech company and not talking about AI, that's a sin. So AI native was by far the most highly valued category of new entrants to the list. These shakes up make this year one of the most dynamic in the history, right? So let's look at 8 years of Cloud 100. 2016 Slack no longer exists in a public market. Stripe 17, 18, 19. 2020 Snowflake came public. Hugely valued. 2021 Stripe, 2022 Stripe, 23 is OpenAI. OpenAI replaced all others to be the most richly valued on Cloud 100 benchmark. Okay. What else? Top highlights. We already talked about this. The category design, collaboration, and productivity is the highest valued category at 110 billion. Second is fintech at 103 billion. So a lot of money going into how can we be more productive. That's what the lot of AI narrative is, right? More productive, collaborate better. And second one is fintech. We introduced AI as what's the difference? AI is a new standalone category with 5 native AI companies making their debut. So there are companies which is AI only, and there are companies that are using AI to increase productivities and all that stuff. Let's look at the average cloud multiples decreased second year in a row down to 26x from 30x last year. So these are the sales multiple, not earnings multiple, if I'm correct. I think these are the sales multiple. Because earnings multiple, I mean, many of the companies don't even have earnings. Okay, let's look further. Last year, we introduced Centaurs, means 100 million plus ARR business. In 2022, 80% of the companies were forecasted to become. Now, the 95% have forecasted to reach 100 million of ARR by the end of year. Right? More revenue, cut cost. That's what the VCs have been asking. Okay, so at a glance, total valuation 60. Yeah, average multiple is 26 times ARR. Still expensive, I would say. 26 times ARR. But yeah, I think if you are in AI, you can command that premium. Newcomers and returnees, 20 top rank now is AI, 95 Centaurs, 55% year-on-year average ARR growth rate. Average valuation is $6.6 billion. That's huge. So #1 in OpenAI, Number 2 is Databricks. Number 6, Klaviyo. Didn't Klaviyo, was it Klaviyo filed for IPO? Or is something similar name? I didn't read. Oh, no. So, they did file. Huh? Okay. So there are three companies that have filed for IPO: ARM, Klaviyo, and third is Instacart. So I'll probably review one of them. Just let me know which one. Share your inputs on which IPO do you want to review when we meet next, which is week after next. We got 3 ones: Instacart, ARM, and this Klaviyo. Okay, I'll go with whatever you want me to look at. I don't have any particular affinity for any individual, any one of these. Insta. Okay, let's see what others have to say. Estimated valuations of top 10 Cloud 100 companies. I'm just trying to read through. Is okay in this case. Well, yeah, so Stripe was $95 billion. Now Stripe is 50. Then we got Canva. Then we got Databricks, OpenAI, Miro, Grammarly. Isn't Grammarly got killed by? No, not Grammarly. That was Calendly. Klaviyo, Service Titan, Talkdesk, Rubrik. So now I think we are expecting Databricks to file for IPO this year. Instacart already filed. Stripe could be another one which may go for IPO this year. I'm not think I've heard any other names yet. Category wise.
Excuse me. Did
Yeah.
you cover Instacart?
No, I mean, next week we will talk about one of the IPOs, so we could pick whichever the crowd wants to go with. So far there are 2 votes for Instacart. Okay, so now talking about AI, even the impact of AI cannot be understated. 55 cloud have announced a generative AI products. I'm not surprised. And even Instacart, I think in their filing have talked, not, where was it? I haven't yet looked at their filing document. Probably it was in some news I was reading is they've talked about how are they going to use AI to enhance shoppers' experience when shopper has a questions around what they are buying. Okay. Somehow every company has to bring in AI into conversation. And 70 are actually using AI or ML, generative or otherwise. Many of these year honorees have embedded generative AI to streamline their workflows in their flagship applications, improving both user productivity and experience, right? That's the one which we talked about is productivity focused. Cloud fundamentals, let's check in their multiples and efficiency. So from a valuation perspective, this is 2023, 17, hold on. Yeah, so valuations are grown over 30% CAGR in last 7 years, which is so 3.4 to 1:10, 17.7 billion. Hold on, I'm just trying to figure out. Okay, so this chart and the side one is different. So average 2023 cloud companies worth 6.6 billion, which was earlier it was 7.4, so little down. No surprises, the valuations have come down. Oh, okay, so these are average top 10 average. This is average 100, and these are the below, what the bottom 10, 1 to 10 from a valuation perspective. They have overall come down, so not at all surprised. We talked about Centaur. What else? Okay. This one is very important. And this is also applying to public markets. After years of defying gravity and reaching record highs, headwinds eventually caught up with cloud 100 fundamentals, right? Eventually, fundamentals will matter because this gravity defying record high in revenue was all driven by free money. Now that free money has disappeared. So if you have putting money in something that cost you, then you will be asking for, when do I get a return? And that's what exactly I mean by the headwinds are now catching up with fundamentals. Headwinds is the cost of capital is going higher. Now they're asking questions around your fundamentals. When are you going to make money? Are you making money? Are you even viable as a business? The questions are being asked, are you even viable as a business? Are you operating profit, or will you always be coming back to the market and see, I need more money to even survive? So those questions are now being asked. So, and no wonder companies have now cut down on growth and started to focus more on how to survive here. So now the mantra is, let's cut the cost so that we don't have to go back to the market to raise additional funds, because we will not be able to raise additional funds at the cost at which we want to. Even the ARM IPO, which is coming, there are some rumors that they are just trying to push it for IPO SoftBank. I mean, ARM may not want to go IPO, but SoftBank is pushing for them because they want to get an exit liquidity. And we may see some of those coming in IPO wherein you are not coming at an IPO at a valuation where you would want it to be, but now you need money. So the best is, hey, make sure you don't need more money to survive. Cut your cost, become operating profits, so that you don't have to go back and tap for private or a public markets for additional funds. If you're tapping a private market, you're not going to get the same valuation that you got earlier. And then the whole cap table, which is, who owned what shares and all that. You talk to VC, they'll be able to explain, but it's going to be, become very messy. And you don't want to be in that situation. Multiples have come down to 26x. And this is, right, 2020, 2021, where we had all the free money. Now, so when you have free money, nobody cares about valuation because, hey, it's not costing me anything. But now, since they start to cost you, VCs have a questions on, why should I pay you at such expensive valuations? So valuations have come down. Let's look at their efficiency in terms of their operations. More tightening in the capital markets, IT budget and consumer spend. Even the public companies are now coming and talking about optimization from their customers. Founder face new challenges in reducing burn and driving efficient growth. This is reflected in all the layoffs that have been happening, especially in the IT sector, right? So you look at an overall jobs number, our unemployment rate is still the lowest, but on the IT or in the tech companies, there has been a lot of layoffs, and the hiring hasn't, they haven't gone back to hiring because of this, right? Everyone is focused on reducing the cost. And if that means we grow a little more efficiently and not crazily, that is okay. The things have changed over the last 2 years. And at Bessemer, we've been always a big advocate of growth at optimal cost. Okay, I guess now you can say maybe this is their law too, but most of the other VCs, especially SoftBank, their mandate was clear to their companies: grow at any cost, right? And they were willing to throw tens of billions of dollars to grow at any cost. And during that time frame, even if you don't have a business models, companies were commanding huge valuations. Work like WeWork, Uber, VAG, Rovers, all these. So I'm generally scared of any companies coming to IPO that has been funded by SoftBank. Because, hey, if you got a rich uncle and he is willing to give you $100,000, doesn't really make you worth $100,000 just because you got a rich uncle or rich dad for that matter. So if SoftBank was your dad or uncle sponsoring you and they are willing to give you or value at $100 billion, doesn't really mean you're worth $100 billion. Right? So very skeptical of especially the SoftBank backed firms when they're coming to IPO. Okay, let's see why do you want to command that valuation? Are you really worth it or not? So getting the focus on profitability, majority of the cloud 100 companies will be profitable by end of 2024. We'll see. This is all forecast. And I don't think they have shared whether it's going to be GAAP profitable or whether it is non-GAAP profitable. Right? You can always become non-GAAP profitable by increasing your, doing some, let me put it that it's easier to become a non-GAAP profitable by considering some of the expenses that you say, oh, it's just one time, right? I did a restructuring, it's just one time. Or we acquired a company, hence we incurred this cost, but it is just one time. Right? But what if you have a serial acquirer, right? Maybe you acquired you have acquired those acquired some companies in the previous years also. Then it is not a one-time cost. But GAAP rules allow you to do it, and then you'll see many of those companies saying, "Oh yeah, we are GAAP non-GAAP profitable." What I would want to see is them being operating profitable. Right? So we'll see. But that's all future, end of 2024. Further improving all the strong trajectory of efficient growth, half of 2023, unprofitable foundries are meaningfully reducing their burn rate by this year. So it's not done yet. The tightness will continue to stay there because I think all the VCs are still asking their companies to reduce their burn. And yeah, 60% have already increased, meaningfully improved their burn, not increased, but improved their burn, means they cut the cost. And coming to the end, efficient growth, how much are you burning per year? Yeah, so it is now 23% is profitable, cash flow positive. I hate this cash flow positive because I have to see how much is the cash flow is coming from stock-based compensation. So I will ignore this. If there is some stats, probably we won't have it because this is private. Yeah, so this is meaningless. 23% cash flow positive. What I would want to see, 23, how much are you cash flow positive by not ignoring stock-based compensation? I guess the number will fall down to cut into half. Most of the companies are giving huge stock-based compensation. I mean, Snowflake, I heard latest earnings report, 45% of the revenue is their stock-based compensation. And then through that, they'll be able to generate and show a lot of cash flow positive, right? Doesn't matter much. So 0 to 25 million ARR, say 15%. Okay. All right. So I think that is the BVP cloud report. Net is they'll still continue to tighten. The market from a job perspective will stay little, continue to be tight till end of 2023. But good thing is the companies that come out to IPO maybe in 2024 will be in much better shape than the ones that came out for IPO in 2021. Okay. Probably we hope to see more profitable companies. Either it is cash flow positive, operating profit, or GAAP profit. So this cohort have learned the lessons of 2022 and 2023. And when they graduate into public market in 2024, hopefully they will be in much better position. So with that, let's end. I gotta go. So we hit our noon mark. Again, no session next week, but in the week after next, I'm gonna review Insta IPO. Plus, let's talk about, I touched upon the details of, option selling. Let's talk about covered call and the various forms of covered call. And how do you manage it? What deltas you want to look at? When you want to do it? Let's go through the whole 9 yards on covered calls and whatnot, and how to generate consistent income. So those will be the two topics. Any other questions? Maybe some macro, etc. We'll look at some news. But I got two topics for the next week session. Cool. All right. With that, let's end the session here. As always, have a great weekend, and hopefully you'll find something good to do next weekend. And I'll see you again week after next. Thank you. Bye-bye.